Okay, so I already talked a little bit about portfolio optimization. What is it? It's actually fairly simple. It's basically you size the positions in your portfolio and hopefully in your diversified portfolio to achieve an optimum balance between risk and return. And a lot of you will already know, risk divided by, return divided by risk is also called the Sharpe ratio. So in some sense, one aspect of optimal portfolio management is optimizing the Sharpe ratio or the risk-adjusted return of your portfolio. Now, in many cases, there's actually more than just that. You know, sometimes you want to avoid a specific concentration of sectors in your portfolio or some factor exposure, whatever. But in the simplest form, it's really optimizing your risk-adjusted return. And what that also means is that you want to achieve a diversification of your holdings, because generally, if you're well diversified and you have a bit of alpha in each of these diverse assets or strategies or whatever, you can actually optimize the overall performance of your trading. And that's really important. Now, as you can already see, I talked about the mean variance portfolio. This is actually what this means. So here we've got the rate of return on this axis, which is just a chart that I pulled from the internet, which is basically your average of returns. That's the mean part of the mean variance portfolio, and the risk is basically it's actually the standard deviation, but variance is basically another proxy for risk. So hence the name mean variance portfolio. Now in AI, we're effectively doing a similar thing. We also optimize the risk-adjusted return. Now, one of the really amazing things, and I talk about this a little bit later, is that we can use AI, in fact, to achieve things that can go beyond just optimizing risk-adjusted return, which is really quite amazing.